India is like an adrak. Where what will grow and how it will pan out is very, very difficult to predict. This strategy will continue to thrive and exhaust investors and excite investors in different cycles. It's in our head that it's value and growth. Ultimately, the thing is that you want to buy a growing stock at a slightly cheaper valuation. But the thing is, if the system has decided that we want growth, you eventually get growth.
Hello and welcome. After a volatile first half of 2025, markets have bounced back, but with valuations once again running high, investors are now asking, is this recovery sustainable or are we back to speculation outpacing fundamentals? To help us unpack what this phase means for value investors and how value funds navigate these cycles, we're joined by Sonam Udasi. He's Senior Fund Manager at Tata Mutual Fund. Welcome, sir. Great to have you back with us.
Thank you, Ruchiraji. Thank you very much.
So, to begin with, markets have staged quite a comeback since the mid year correction, though they're still shy of earlier peaks. So, do you see this rebound as the start of a durable phase, or are we once again in a zone where valuations have raised ahead of earnings?
So the good part, uh, you know, all said and done, what the market did, if I step back, since October of last year, October to Feb, we had a massive correction.
Hmm.
Okay, valuations corrected, FIs pulled out in a big way. Then, you know, basically the policymakers did a 360-degree turn. So you had massive amount of liquidity, taxation reprieve, and the growth mode is back. So all policymakers, whether government or monetary, everybody was on the same page that we need growth back. Um, so that's where the market sentiment started to improve a little bit. But even as we speak today, both the Nifty and the Nifty 500 are about 5% premium to a long-term 10-year average. So on a trailing basis and both on a trailing and a forward basis. So it's not as if that you are super, super expensive or it's a bubble that's brewing. There are pockets which are, in any market, there are pockets which are overzealous and there are pockets which nobody wants to touch. Um, so today, I would not say that we are a very expensive market. I would say that we are not a cheap market. Uh, Now, I think the thing that we are watching out for is whether the earning trajectory improves. Uh, September of last year, September of 24, that quarter, Nifty 500 earnings degrew by 1%. Okay, there was a negative growth in the Nifty 500 in earnings. And therefore, the GDP growth also was below 6% during that time. Since then, there has been a steady recovery from that lower base. So you had a 4%, 5%. In June quarter, the September quarter Nifty 500 earnings are not fully out. But the June quarter, the earning growth was 10%, 9.6% to be exact for Nifty 500 as a whole. That means slowly but surely earnings have started to improve, maybe because of low effect, etc. But the data has started to improve incrementally. The GST cut would have helped definitely. Uh, I think the low base of last year, September and December, they were one of the worst quarters in terms of size of growth. That you would see a positive indication both in September and December. So that is one sort of reason for the markets to stay a little bit hopeful from a sentiment perspective. The other thing, if I look at it, is that the FIs are still selling. I mean, they are not selling in that proportion, but they are still sellers. I think that's simply because they are worried whether the tariff deal will happen or not, because After China, we are the second highest tariffed nation
Yeah.
on the globe as we speak today. So there is hope that as we get closer to the deal and there is some amount of deal, uh, then that negativity from the FIs will sort of go away. Uh, so there is a definite liquidity flow within India. That's why you are able to sustain this hope, and your valuations are still slightly higher than average, in the hope that data is improving, and then FI selling will sort of cool off at some point in time and we'll have a deal. I think that's the context of the market currently. If any of the two was to sort of fizzle out, then you will probably have a have a problem.
Sir, now we have seen that mid cap and the small caps have recovered sharply after their correction earlier this year. Is this bounce back rooted to the fundamentals, or are we seeing the retail exuberance making a comeback?
So I think as a pack, when we talked about Nifty 500 in June quarter, the pack that did the biggest amount of heavy lifting in terms of earning growth was the mid cap pack. It Large cap did slightly less than mid cap, and small cap was the worst. So mid cap as a bucket did fairly better in the earning growth trajectory. So I would say that some of it is definitely earnings led. There is no doubt about it. And I think after the cool off from October to Feb, uh, both the lot of this small caps, especially barring the mutual fund industry, etc. Lot of the froth is also because of private participants, HNIs, etc. I think they have started to become very, very careful with how are they allocating money. If you see the market breadth, you will still see that it's not as if there is over exuberance in many, many things. If there is data to support it, then that those stocks or themes keep getting re-rated. If the data is not very strong, or the earnings is or backing them, or revenue trajectory is not very strong, it just fizzles out in a month. So I think that's a very, very healthy sign that the market participants have become very, very careful in how they are sort of looking at things and allocating money.
Right. So, growth and momentum themes they have continued to lead, while value funds they lag behind. So, why has this divergence? Why has it lasted so long? And what typically brings markets back in line with fundamentals?
So typically, in a 3.5 year cycle, last 20-25 years, if you see, and this is true globally, every 3.5 year cycle, value goes through 1.5 year cycle, which nobody cares for value. Same for small cap. I can give an example. Post COVID, about for 1 year or so, nobody wanted to touch a small cap or a value category. And when they said, the next was the most bombastic for both these categories. Both small cap and value did extremely well, because when things they improve, first they improve on the higher side. People go where visibility is very clear. Once that is done, the next leg is always in that, okay, this will improve further. And today we are standing at almost that crux of both these categories, I would say. Uh, because the Nifty and Nifty 500 P multiples are not very, very high. As it normalizes further and you get into some amount of excitement, either through earnings, which you will get to know when September quarter ends, and even December, and also if there is a tariff announcement, if the sentiment improves. Today there is actually, if you ask me, there is nothing wrong with the valuation per se. You cannot hold valuation responsible for market sort of, let us say, lack of any exuberance. The only thing that has changed is the sentiment. The sentiment 1 year back versus today. That is what has changed. So the sentiment needs to come back. For that, the earnings has to improve, which is improving slowly but surely. But also, if external factors like a tariff deal something normalizes, then things start to improve materially. Uh, there is no dearth of flows into the Indian equity markets. Local investment continues. There is no leverage in the system, whether it's the banking sector, whether it's large individuals, whether it is corporate India, the top 32 basic industries, most industries are sitting on leverage of zero point 0.4 or less, uh, which is something that you have the cushion to take any external shock that could come in. So this is not a bad situation to be in. Now you are just waiting for things to sort of improve. So hopefully, if earnings improve themselves, because the GST cuts would have improved affordability in the system, like people would have afforded more. And now let's see where it goes and which are the pockets that benefit from that. Uh, and that will sort of drive your sentiment and uh, earnings momentum forward. Again, I would just to highlight somewhere in September of 2022, Nifty 500 again had done the same thing. Nifty 500 earnings was down 2% in that quarter. After that, the next trajectory was 8% growth, 10% growth, 15% growth, 52% YOY. So you cannot really predict. Actually, I say in India is like an adrak. Where what will grow and how it will pan out, very, very difficult to predict. But the thing is, if the system has decided that we want growth, you eventually get growth. And therefore, if you are behind growth, eventually earnings will follow through. And as that trajectory improves, hopefully, whether we get a deal or no deal, uh, fundamentally speaking, you will continue to become more attractive. Because Nifty, all said and done, last 1 year has done nothing. In terms of it's hardly, I think, up 3 or 4%. And that's also in the last month. Till a month back, the return was zero, really.
Yeah.
Now, sir, if we look at the Tata Value Fund with a 3-year alpha of close to 4%, it sounds paradoxical to label your fund as an underperformer. Yet, that's how the category relatively shaped the perception. The recent quarter end numbers show that the post corrections, things have rather been unsettled. Have you made any portfolio adjustments since then?
So, slight adjustments you have made. What has become value in the last 6 months? What has become cheaper? So, IT sector has become cheaper. We have slightly increased because value, you can identify something as value, and we discussed it the last time. When do you have to go in, and when is you have to go in when the trigger is nearer? That's where you will sort of capture it faster. So while we have slowly added a little bit of IT, but we are still taking our time. What we have incrementally added is say weights in some of the NBFCs, some of the market participants. We have reduced some pharma weight incrementally. We have also reduced some energy weights that we had. Uh, we have added, we were out of defense. We have added defense in the last 6 months because its earnings have become more, visibility has become better, and valuations have become cheaper. So those are the things that we have done, and there are few things that we keep doing. We also are carrying a little bit of cash, but it's more rotation driven, nothing very specific. So today, if you ask me from an earning improvement trajectory, if I'm saying that earnings are going to improve, are you mapped to it completely? I think we have got all the right, mix there in terms of earning momentum improvement. Uh, I forgot to mention that we own a decent amount of two-wheeler auto OEMs. That also has sort of, we think earning improvement will surprise, and that will also play a part in where we are. See, generally this fund has always had this last 20, 21 years. This has been in operation. every 3 4 years the fund will act like as if there is almost a 6 7% kind of lag between the nifty and the fund. When it sort of comes back, it surprises even the fund managers how did it do. And after 3 years, when you look at it, there's no difference between the Nifty 500 and the fund per se. So it generally takes care of, because nobody's interested in certain pockets. For example, one of the largest sort of consumption names uh, in tobacco, etc. Nobody's interested in right now. Done nothing. That it's very very cheap versus its index. There's a dividend yield play of 4.5%. But for now, nobody is interested. There's nothing incrementally wrong. But when the market becomes interested, when market sentiment improves, and say the Nifty P on a forward basis, which is at say 20.5 or 21, starts becoming 22. Imagine what happens to these kinds of stocks. They just so that's what the nature of value is, and that's what we tend to operate in. I mean, that's the mandate of the fund.
So, Tata Value Fund has lagged peers recently, even as it continues to maintain one of the lowest Ps in the category. So, do you think this strict valuation discipline has worked against you in a market favoring high multiple growth names? And also, could this phase of value underperformance actually set the stage for a reversal in the long run?
So generally, how I look at it is, what are you holding, and does it have earning momentum going forward or not? Uh, so I think we are fairly confident of the construct that we are carrying in terms of earning momentum and improvement. Um, I would also say that we are not a very, very deep value fund. We are like 70/30 ratio that we follow. Currently, low P or very low P stocks are about 76% of the portfolio. 20% there is a high P bucket, but some of them are really turnaround stories. Uh, we are cheap, but we do not follow, we are not a deep value fund. I think we are fairly positioned for a market sentiment revival. Uh, there is no earning, like if I look at what is the ROE of the portfolio versus the benchmark, our ROE is fairly higher than the benchmark. Our price to book, we are much cheaper than the benchmark. So the from a quality of the portfolio perspective, it's a very good quality portfolio because it has a lesser valuation and a better quality of earnings. This is what you really are looking for. So I think we are fairly confident of where we want to grow from here.
Right.
Now, sir, you often taken a contrarian approach within the value framework. Did you consciously sit out of the certain parts of the recent rally because valuation didn't fit in the overall lens? And how have you those calls played out so far?
So I think, see, to be fair, in the higher P stocks that we own, we are allowed to own up to 30% higher P stocks. Within that, we played the platforms that performed in this rally, right? All the platforms that we talk about. We own that, and we have had it fairly early. Fortunately, we cannot buy as much as a growth oriented portfolio would buy. Our weights will be slightly lesser. There is a constraint, but we identified that and we played that. Uh, and we can only do so much because that's the nature of the fund, and you have to be true to that nature. There are otherwise you're what is the difference between you and what we have tried to do incrementally is, as I said, look even deeper. Whatever in value you think is going to take longer to work out. Like I said, IT is coming in value bucket, but we have not gone and made it like double the weight of the index. We are slightly underweight the index even today. We are waiting and watching, and we are still slowly adding, but we have not taken the view that it'll substantially improve. We can't see that right now. Once that clarity emerges, we'll add weight here. But right now, today, our large weights continue to be banking financial space. Uh, some bit of energy, some bit of power. Power also, I should mention, power has been out of favor as a theme for the last 8 months, simply because power demand data just collapsed. That peak demand data, we think Jan, Feb, March, people will start to see, and already there is a moment within that theme. So I think we are overweight there, and that should also help out going forward.
Right. So the last time we spoke, you mentioned that heavy exposure to financials, which lagged during the downturn, and investments in power ecosystem also, which fell as much as mid caps despite being attractively valued. That did hurt performance. So are these still affecting returns, or have they started to help the portfolio now?
So financials have started to help the portfolio for sure. All sorts of financials, whether NBFCs, banks, or even capital market participants.
You mentioned
Uh,
you incrementally added NBFCs.
yeah, and also even I would argue that the power ecosystem or the energy ecosystem, power plus energy, I think that has also started contributing. At least it's not giving you a negative drag anymore. It has started to improve. You can see signs of life in that segment. As data improves there, I think investors will realize, and that value at some point will become valuable, which is the case in most cycles.
Right.
Sir, now, there is one recent IPO going on of a eyewear retailer, which has seen a heavy bidding from the large institutional investor, despite demanding valuations, whereas you all have stayed away from the IPO. So, what drives that restraint, sir?
So I think it's not while I run a value fund, you are aware that I run a consumer fund where the P is exactly opposite this, where the trailing P is 60 plus or something. So you evaluate everything. I mean, we have evaluated everything. As you said, uh, we don't mind paying a P multiple. Even in this fund, that in the value fund, we own quick commerce. The weight is smaller, but we own it. We look at the size of the opportunity, the total addressable market, and how fast it can grow for how long. And there, that's the reason we said, okay, this is too small a bucket as a consumer category to pay such a high multiple and to hope that it will continue. Maybe people are right, but we took a view that it's not really for us.
So nothing on the valuation side, that because we have seen valuations multiple going up within last 3 months from around 7,000 crore to 70,000 crore. So nothing to do with the valuation as of now.
See, we would have, obviously, if you ask me, had it come cheaper, would we have been more interested? Yes, because the category itself is growing. Uh, they have done a wonderful job on doing the back end, etc. But that's part of the business. So we like the business, but we didn't like the valuations. It's as simple as that.
Now, let's talk about what value even means today. So, in a market where many quality companies they trade over 40 times earnings, how do you define value now? And is PE still a useful lens, or do you rely more on cash flow strength and capital discipline?
So for us, really, P is the starting point, right? Because it's in the SID. The starting point is that you should, like, for example, if I was to run a screener and say, okay, give me stocks which are lower than Sensex P. So I'll probably get, out of the 8,000 stocks that are listed, I'll probably get 2,500 stocks which are lower than the Sensex. Out of that, then you say, okay, what are the sectors that I am interested in, which will grow faster than the Nifty or Nifty 500? Within the Nifty 500, what are the sectors that can grow faster? Can you identify them? What is the ROE, ROC of that? Then you go fine tune. This is just a starting point. Then you fine tune, okay, what is the ROE, ROC of the business? How many times has the promoter come and raised capital? How many times has the investor got diluted? Those are factors, fine things that you look at. Acha, is it part of an index? How liquid is it? Those are things that you keep doing it, and when you realize, then you add weights. A lot of the weights that you see in the fund, the top weights, are one, the trajectory, and also because what kind of liquidity that they provide. You cannot have a very, very large weight and concentrated weight. Either you are very sure of it that, I will get my nirvana A to B, but otherwise, what you try and do is, okay, the growth has to be better than Nifty 500. It has to be cheaper. And if it is liquid enough, which is additional, then I can have a large weight. And then I can play it to the largest point in NAV. That's how we have actually outperformed in the past as well.
Now, sir, historically, value tends to regain favor after the rate cuts or the markets have corrected. But in the recent year, many argue that the markets have moved on and that investors now chase growth and high multiple stories instead. So, from that context, what future do you see for the value investing in the near term? And can it still make a meaningful comeback as earnings strengthen in 2026?
I'll say a very simple thing. Whether it's you, me, portfolio managers, investors, why we are interested in equity. We are interested in equity as an asset class because all of us want a growing company at a cheap valuation. If you can find that balance, then you know that at some point this value will become valuable. You want growth. Growth ultimately, as an equity investor, your objective has to be that I want to, invest in a growing company. At the same time, I want it a little cheaper for me to make some amount of extraordinary money. I think that's what value category. So if the current context is that the P multiple tomorrow, for example, or on a trailing basis, because of all this becomes 26 times or 27 times, it is 23 currently, then my universe becomes bigger, firstly. And with that, if that happens, then the lower end of the market, which is trading at 10, 12, and still growing better than the market, will tend to get re-rated faster. So I don't think that whether, it's in our head that it's value and growth. Ultimately, the thing is that you want to buy a growing stock at a slightly cheaper valuation. That is the context of any investor globally. It doesn't change. I think within that context, this strategy will continue to thrive and exhaust investors and excite investors in different cycles.
Now, sir, the value category has seen many passive options like Nifty 500 value 50, Nifty 200 value 30, and a few of others. Most of which are the with the 30 or 20 or 30 stocks portfolio. How do you view this index-based value funds as a part of investors' core portfolio compared to the actively managed funds?
And I say this for any category, active versus passive. Because India is still emerging, your per capita income is $3,000 currently. You're still evolving. Your capital market is not deep enough. There is a width in terms of sectors that you can play now. There are themes, etc. But we are still evolving. We are still not sophisticated enough. So as long as you're not sophisticated enough, and there is still an advantage, active funds will always give you that benefit when the cycle turns completely, because you will do a better job of choosing of what kind of stocks and themes that you want and in what concentration.
Now, to wrap this up, which sectors or themes excite you most today for bottom up value discovery?
I think the view remains largely the same. One, I think the industries that will double in the next 5 7 years. One is in consumption. It's women centric. As more women in the workforce, that means uh, households have to function efficiently. So whichever category where penetrations are less, whether in food processing, whether in consumer appliances, and that categories will do extremely well. And you have to hunt for growth plus value combination. uh, at the same time, uh, within the financials category, the financial services piece, people are more inclined to plan wealth, plan invest, look at outcome. So any platform based or any capital market based theme that is doing a good job and it's created a brand and a following, uh, because it does not require capital beyond a point. That theme will also do well over the next 5 7 years. It will be very volatile. It will just test your patience. But point to point, the size of the industry will continue to do well. Those categories one needs to focus on. Cost, because energy has become very, very dominant in global, dealings with each other. There are tariffs, etc. So to hold all energy within your borders and to have, sort of ring fence them, those themes also I think will do very, very well, and one needs to do deeper research on some of the other categories which are emerging. Even energy storage is a good segment to look at. These are some of the things that come to mind. Also, because now over the last say 8 months, the government focus is back on consumption and driving consumption within the country. I think one needs to be sort of looking at this space also very proactively and positively, for at least for the next 1.5 years, because there is sort of a recoup of valuation possible in this theme versus capex. That was the theme, say 3 years, for 3 years continuously.
Well, with that, time for us to wrap up this chat. Thank you. As always, it's been a pleasure hearing your perspective, and thank you for taking out time and joining us today.
Thanks a ton, Ruchira. Thanks, Chirag. Thank you.
Thank you, sir. Thank you.
And to our viewers, if you found this conversation useful, please don't forget to like, share, and subscribe to our channel for more insights from India's leading fund managers.